What if I told you that the money sitting in your nonprofit's bank account right now might not actually be yours to spend?
Excuse me?
What?
I'm not talking about fraud. I'm not talking about embezzlement. I'm talking about something far more common and far more dangerous because it's completely legal, completely normal, and completely misunderstood by a lot of nonprofit leaders.
I'm gonna need a little bit more information.
You can have six figures in your checking account and still be 3 months or less away from closing your doors forever.
Well, that's terrifying.
And the most terrifying part, most nonprofit leaders have absolutely no idea it's happening until it's too late. Welcome back to From Purpose to Profits. Well, hey there. I'm Kimberly Ferguson, CEO and founder of The Emerald Edge. This is the series where we stop pretending that passion alone pays the bills and start building nonprofit organizations that are financially strong enough to actually finish what they started. Last episode, we talked about martyrdom, the identity trap that keeps nonprofit leaders stuck in voluntary financial suffering. Today, we're going tactical because now that you've given yourself permission to build a financially healthy organization, you need to know what financial health actually looks like. And spoiler alert, it does not look like your bank account balance.
You're off to a strong start.
So here's the scenario I see constantly. A nonprofit executive director pulls up their online banking. They see $180,000 sitting there and they feel a moment of genuine relief, maybe even pride. And then payroll hits or the lease renewal comes in and the grant report is due. And suddenly that $180,000 has a very different story to tell. So let me give you 3 reasons why your bank balance is lying to you. And none of them require anyone going to jail.
You could go to jail.
So reason number 1 is your bills. This one sounds almost too simple, but I promise you it is the most overlooked financial blind spot in the nonprofit sector. You have $180,000 in the bank, but you also have $250,000 in accounts payable sitting in your accounting system. Vendor invoices, utility arrears, a contractor you've been paying in installments, a line of credit that you've been quietly servicing for 2 years. Do the math. You don't have $180,000. You have negative $70,000 with an optimistic bank statement.
Oh God, is that like math?
And here's the dangerous part. If your revenue is also declining month over month, that gap isn't staying at negative 70,000. It's growing every single month quietly while you're out there doing good work and assuming the finances are fine because the account hasn't hit zero yet.
Cool. Yeah. If it ain't broke.
The bank balance tells you what came in. It does not tell you what's already owed going out. Those are 2 completely different numbers, and really you need both to understand where you actually stand.
Both is good.
So reason number 2 is that money might not actually be yours to spend. In the nonprofit world, not all dollars are created equal. There are, as many of you probably know, the 2 types of funds you need to understand right now. The first is restricted funds, and that is donations or grants that are given to you for a specific purpose. A donor gives you $50,000 to run your after-school literacy program. That money is legally designated. You cannot use it to pay your operations manager. You cannot use it to cover your electric bill. It is not your money to move. It is your money to steward.
Look, but don't touch.
And then we have unrestricted funds. And those are the dollars you can actually run your organization with. General operating dollars. The money that keeps the lights on, pays the staff, and covers the costs that don't fit neatly into a grant budget. So when you see $180,000 in your account, the first question is never, how much do we have? The first question is, how much of this can we actually spend? Because if $150,000 of that is restricted grant funds tied to 3 different programs with 3 different reporting requirements, you don't have $180,000. You have probably $30,000. And if you also already have $250,000 in accounts payable, you don't even have $30,000. You have a crisis wearing a business casual suit.
Undercover? In disguise?
Reason number 3, and this one's the one that nobody wants to talk about. Sometimes the money is gone because someone made sure it was gone.
Oh, me?
Now, I'm not here to point fingers at anyone in the room, but I would be doing you a disservice if I didn't acknowledge that financial mismanagement, whether intentional or not, is one of the leading reasons nonprofit organizations find themselves cash poor despite healthy-looking statements.
Oh my God, the call's coming from inside the house.
And the most documented example of this in nonprofit history, United Way of America.
Can you tell me a story?
It's 1992, one of the most recognized nonprofit brands in the country. Hundreds of millions in annual donations flowing through their network. A household name synonymous with community giving. Their CEO, William Aramoni, was earning $390,000 a year plus $73,000 in additional compensation. But underneath that, $1.2 million in charity funds had been redirected through subsidiary organizations for personal use.
That's insane.
Condos, travel, gifts. A 53-count federal indictment followed. Aramoni was convicted in 1995. But here's the part that gets buried in the headlines. Local United Way chapters across the country had been funneling donor dollars upward with no clear picture of where the money was actually going. The financials looked like they were flowing. Nobody was asking the hard questions underneath the surface.
What did we learn?
The lesson isn't just about fraud, although that's obvious. It's about what happens when an organization at any level mistakes activity for health, and the money appears to be moving and leadership assumes that that means everything is fine.
Everything is not fine.
United Way survived, but it took years of painful restructuring, lost donor trust, and complete financial overhaul to do it. Most nonprofits don't get that kind of second chance.
One chance.
So whether it's hidden debt eating your cash, restricted funds you can't legally touch, or financial mismanagement that's gone undetected, the common thread in all 3 scenarios is the same. You were only looking at part of the picture.
Where's the rest?
The bank balance is one data point. It's not a financial health report. And running your organization off of one data point is like a doctor diagnosing a patient by only checking their temperature. You need the whole picture. And the metric that better gives you the whole picture, well, that's the solvency ratio.
Which is what exactly?
If you haven't heard of this number before, allow me to introduce you to one of the most important financial ratios in your entire organization.
Whoa, slow down, Bob. Let me get a pen.
Simple definition here. How well can your total assets cover your total debts? The math is very straightforward. Take everything your organization owns, cash, equipment, receivables, property. That's your total assets. Now look at everything your organization owes. And that's loans, accounts payable, deferred revenue, outstanding obligation. That's your total liabilities. Divide assets by liabilities, and that's your solvency ratio.
That sounds simple enough. Let's just do that.
So here's the benchmark you need to know. A 1-to-1 ratio is your absolute floor. $1 of assets for every dollar of debt. That's the bare minimum for an organization to have any realistic chance of recovering from major financial hit.
Ooh, that's good.
Anything below 1-on-1 means your debts exceed your assets. You are technically insolvent. And no amount of passion, programming, or grant application fixes that without a structural financial intervention. A more healthy target would be 2-to-1 or better. $2 of assets for every $1 of debt. That's where you have that breathing room. That's where you can weather a funding gap, a lost grant, or an economic downturn without going into crisis mode.
But you have a really good safety net.
So let's go back to that executive director with $180,000 in the bank. If their organization also carries $400,000 in outstanding debts, vendor payments, a line of credit, deferred payroll obligations, their solvency ratio is 0.45-1. They don't have $180,000. They have a crisis with a nice looking bank statement. So here's what I want you to do before our next episode. Pull your most recent balance sheet. Find your total assets and find your total liabilities and do the math. That number is your solvency ratio. And whatever it is, you want to know it. Not to panic, not to spiral, but because you cannot fix what you refuse to measure. So if you don't know where to find your balance sheet, or you're not sure you're reading it correctly, well, that's not a character flaw. That's a gap, and we can close it. Use the link below to connect with us at the Emerald Edge. This is exactly the kind of financial clarity work we do with nonprofit leaders every single day.
It'll change your life.
This has been From Purpose to Profits, where we prove that doing good and doing well aren't opposites. They're partners in creating lasting change. And remember, a healthy bank balance is not a financial strategy. Knowing your numbers is. And if you're sitting there thinking, okay, Kimberly, I ran the numbers and, well, they're not cute. Well, first of all, good. Now you know. And knowing is the only place a real turnaround ever starts.
I am learning so much.
In our next episode, we're talking about the 3 reasons every nonprofit needs a 10 to 20% profit margin and exactly how to build one without your board losing their minds. I hope to see you there. Keep on leading with purpose, and I'll see you in the next episode.